In this video, we're going through a simplified approach to consolidating the balance sheet between a parent and a subsidiary. And so we have two companies here, the parent company, Big Guy Inc., and a subsidiary, Small Dude LLC. And the scenario that we have is that Big Guy Inc. acquired 100% of Small Dude LLC common stock on December 31st, 2023. Big Guy paid $2 million for this investment. Go ahead and prepare the consolidated balance sheet on acquisition date. That's the topic of this video. Let's dive right in. All right, so what we have here is a parent company, Big Guy Inc., that purchased an investment in a subsidiary, Small Dude LLC, and he paid $2 million for that investment. What's required here is to prepare the consolidated balance sheet on the acquisition date. So let's go ahead and do it, and I want to do it in 3 easy steps. So I want to simplify this as saying step 1, combine, step 2, eliminate, step 3, consolidate. So let's go ahead through the process. The first step is going to be to combine all the accounts on the balance sheet, assets, liabilities, and equity. Let's go ahead and combine these accounts. All right, now that we combined all the accounts in the balance sheet, we want to check that the assets always equal the liabilities and equity. So always have a formula here at the bottom that checks that your total assets equals your liabilities and equity. And this file here is going to be available in the description of this video, so you can download it. There will be 2 tabs, one for you to exercise. It's going to be the actual exercise we're going through. And then the second tab is going to be the answer key so that you can check your answer against what I have here. So that's step number 1, is to combine straight up 100% of the assets, liabilities, and equity of the parent and subsidiary at 100%. Okay, now step number 2 is going to be to eliminate. And this is the point that I want to make here, is that if you understand this concept here, you won't have to memorize what we're doing. So understanding the logic is important here. So what we're going to eliminate here is we're going to eliminate the investment on the asset side from the parent. So if you look here, the parent has an investment in sub $2 million sitting as an asset. We're going to eliminate that. The reason why, and this is important for you to understand, the reason why we eliminate the investment in subsidiary is because we purchased their assets and liabilities, and we're going to add up 100% of their assets and liabilities with our assets and liabilities. If we keep the investment, this is the key point here, if we keep the investment, we'll be double counting. And we don't want to be double counting, right? So this is the interesting point, or the important point to understand here, is that you eliminate the investment in sub because you already combined their assets and liabilities, and now you have to get rid of the investment in sub. Otherwise, you're double counting. Now, when we eliminate the investment in sub from the parents' assets, we're going to eliminate that against the equity of the subsidiary, right? So let's go ahead and do it together. So the eliminate step is going to say equals negative $2 million, which is the parent investment and subsidiary. And we're going to eliminate that against the subsidiary's equity. So negative their equity, and drag that down. So that's the second step here, eliminate. Now, the third step is going to be to consolidate, which is going to be taking the amount you combined in step number 1 and adding step number 2, which is the elimination entries. So let's go ahead and enter in the consolidation balances. Again, when you enter in the combined consolidated balances after elimination, you always double check that your total assets equals your liabilities and equity. If you're new here, welcome to the channel. My name is Bill Hanna. I'm the financial controller. I've been a controller in New York City for the last 10 years or so, and I share my experience here in this YouTube channel, as well as my website, the Controller Academy, which is a platform on which I share everything I know about being a corporate controller. So go ahead and check that out as well. Now, notice the parent company acquired 100% of the subsidiary, right? What if in a different scenario, the acquisition was for 80%, not 100%. Well, in this case, you'd still be combining 100% of assets and liabilities. However, you'll enter in a line for non-controlling interest. Non-controlling interest line equal to the 20% that you don't own in the subsidiary. And that will be 20% of the net assets of the subsidiary entered as an equity line item in the consolidation. This video here, though, is a simplified approach, so we're not covering non-controlling interest. We'll try to cover that in a future video. But I just want you to know that if the acquisition was at 80%, there will be the 20% non-controlling interest that we will be entering at the bottom as an equity line item for the 20% of net assets of subsidiary. Okay, so this is the approach here, and if you like the video, I hope that you will give it a thumbs up and share it with someone who will benefit from it, and I'll see you in the next video.